Hello, everyone. This is Brad Matheny. This is the start of the Ment.com webinars. I see we have Jason and Ann here. I don't expect a lot of people. This is the first webinar. So we will see what happens. And we'll go from there. I'll give it a few more minutes, get everyone in here. Remember, type in your questions if you have any direct questions for me. I'm just learning this software. It is being recorded. So we shall see what happens. I'm expecting Jamie, the developer of the Clockwork Group applications, to join us, but he was traveling by air, and I'm not sure he's going to make it. So we'll see. Okay, so we'll give it a few more minutes here. Hope everyone's doing well. Quick little look over here. Let me come back over here. And what an incredible rally phase here. Oops. I mean, this is a massive move. Really, you can see it. Let me change this one. Now we'll leave that one. We'll change this one. What an incredible move. This is just massive. When you look at this move to the upside here on the ES, it's just an incredible rally phase taking place. So very difficult here. So especially for the shorts. But again, long term, we're trying to stick with it here. So howdy, Jason. Yeah, I see your message. Feel free to, like I said, ask some questions. We're going to go over a few things here. Try to turn this into an ongoing resource for members. Hopefully, you can hear me well enough. And see what time it is. 12 o'clock. Okay, so Ment.com. What is Ment.com and what do I do? Let's kind of get into it. So, Ment.com is a website that I have owned since 1997. I started out doing custom programming a long time ago, back in the old DOS days, a long, long time ago. Actually, in the 1980s, 83, 84, 85, back in the computer era. I started doing a lot of custom programming for people with new computers, didn't understand them. I was a very young kid, about 23, 24, had already learned to program in different languages and just basically, help people learn their computer, learn how things work. I moved into the trading field in, thank you, Ann. Yeah, I saw your message. I moved into the trading field in 1986 when I started trying to trade with a friend of mine who eventually became a business partner for the development of the Candlestick Forecaster product, which was my first foray into this market. Long and short of it is, in 1989, the guy that I knew, my ex-business partner Gary Wagner, who's still friends with me, we're going to start doing some webinars together. Gary and I, he's still around, and I'm still around, and we're kind of bringing the old team back together somewhat for webinars. But anyway, he came across a book called The Japanese Chart of Charts by Seiki Shimizu, and showed it to me, and told me that this is going to be the next biggest thing. Could we create a program that identified Japanese candlesticks? And of course, me up for a challenge, I took a couple of pages of the book, read through it, went off for about 6 or 7 days with my trusty compact portable computer. You remember those things? They look like briefcases, weighed about 60 pounds. But anyway, went off and wrote a program that was able to graphically display data, that was able to import comma delimited files, and was able to do basic candlestick interpretation. I only had 7 or 10 patterns in there through what I called an inference engine, which was a very simple form of artificial intelligence. That got us started. After about 10 days, I showed it to him, showed him how it works, showed him what we could do, and he loved it. We continued to expand it out. And in 1990, we showed it off in Santa Barbara at the MTA conference, Market Technicians Association. Steve Nissan was there, a bunch of other people. Steve Nissan's first book was being published at that point. Very nice guy. It was kind of cool that we were showing off our little candlestick software. first version. I mean, very first version, still in development, really. And Steve Nissan came up and started looking at it. And anyway, that got us started, got me started. And I started in 1989 at that point, 1990, getting into the field, learning from some of the best technicians in the planet. Now, over the years, as you've seen, now this is something I'm going to show you here just briefly. This is my remote server. This is eSignal. These are the primary applications that run. These are the screen captures that I show you. This is my cycle system. All of this is code. So, you can see here, here's an example of code that I write. This is what I do. I write code all day long. This is a short little version of a semi-automated trading system. I have other automated trading systems. I have the TT scanner software. I have the hot list running. I have uh, this is an automated system that's just not running right now. I have my fib charts data, which you can see. This is the predictive modeling system. This is the one where I can, point to any bar and double click on it, and it will predict 15 bars into the future. So if I want to see what's going to happen over here on the SPY, I can just double click on it, and that's where it thinks the SPY is going to go for 15 to 20 bars into the future. What I do with this to try to get a gauge for what's happening in the market is I will start about 4 or 5 days back, maybe back in here, and I'll start picking dojis. And the reason I pick dojis is because I want to see what the system says is going to happen near bottoms and near tops. So as we're looking at this, these are the lower downside ranges should we break downward. And these are the upper ranges here around the 420, 421 area. And these are daily. So the most likely outcome at this point is to roll into this area. These green areas represent tops, the red areas represent bottoms. But then I have to measure that into what's actually happening on, uh, yeah, maybe, Michael, maybe. But then I have to come out here too, and I'll read. I don't know. Can you guys see each other's comments in chat? You guys might be able to help me out here as I'm learning this thing, this new webinar software. So here I can take a look at what's likely to come in this area. And this gives us the range here that eventually downside moves were likely to be in this 380, 390 range, whereas upside moves are still moving very cleanly up into the 420, 430 area on the SPY. So if I were to look at this and I were to determine what is likely to happen, given my cycle analysis, I would say that, in that same range that I talked about, we have this 420, 428, 430 area potential type of a target up in here. Whereas if we do get downside predictions, we're going to see this move downward here. Now, the other thing that's interesting is this actually gives me probabilities of success. But again, probabilities of success have to be taken within reason, because the way this maps, that was a great pattern. Let me clear this and show you. So here's an example of nailing a low, and that's why these lows are so important. So when we take a look at this, so understand that it's mapped out here. I come in here to tools, output, and ignore all of this. Just focus on this right here. So from 0 days out, we have a 87%, 100%, 100%, 62%, 75%, 75, 75, 50, 50, 75, 75, 75, 75, and then 50, 50, 50. That's what these little white bars are here. This white bar means it's a 50, 50% probability. But again, it's mapping the moves very well. This pattern consisted of 4 patterns. It is what's called a tech pattern. It's a pattern number 20 in the record. There were a total of 4 of them. We've got the high range, the low range, the probability, and the outcome. So obviously these tops and bottoms, they tend to work very, very well for predicting up and downward moves. So this tells us that we have some consolidation here and a potential for a move to the upside. These are weeks. So we're looking at some sort of a movement back up into this area, maybe a little outside the range. You can see how outside the range of predictions we are here. So this is again looking very solid moving forward. And yes, I'm showing you some things here that kind of are behind the scenes. This is my Fibonacci predictive modeling system. This is a adaptive Fibonacci system. It essentially identifies target ranges. So there's my 424, and there's my 456, and there's a 461 up here. You can see that this basically plays into the overall outcome of my longer term projection. This is something that's taken 3.5 years to build. It's very, very cool as far as what it does, but it is still reliant on my interpretation. This is a weekly data. So again, if I come down here to daily data, then we're going to get shorter term predictions. And you can see here, the way you interpret this, ladies and gentlemen, is you're looking for the last breach of these levels here. So for example, the last real breach was this green bar moving upward. You can see the two red bars here. They've moved out of the way because of consolidation. So we have not moved into bearish trending yet. We are still bullish off of this trigger here. We did see some rotation across this area. You can see we went bullish right above this area, rallied up, went bearish down below this area, came down, went bullish up above this green area here, rolled up, and the adaptive Fibonacci system moved the trigger levels down here because of consolidation. You can see we just went with a new trigger here off of this peak, bullish right here. So this is a brand new trigger right here. It looks like a beautiful little setup, and we are moving back into bullish territory, moving up towards the 421. And now look at this. This is again 421.69, 427.47, and 431.60. So there are our targets. Try to draw this for you. So really, we're going to kind of move to here, maybe up to here, maybe up to here, and that should be about it. Now, again, I think the topping is going to happen between May 10th and May 20th, but we'll see how that plays out. Obviously, trying to short this market, if you are short or trying to short this market, your real zone of opportunity is going to be in that May 10th to May 20th range, closer to May 20th. Oops, drew that wrong. Which is really going to be more in this range, pretty much right in here. We may get a little bit of a blow off top. So understand that we may get some kind of a blow off topping pattern where it could go a bit higher. But I'm not 100% sure that the market has any more upside move to it roughly once this 425 level is hit. So about 425, let me draw a line, roughly 425 could be about it as far as I'm concerned. Okay, I do not believe we're going to see a huge move above 425 right now. So, a couple of questions coming in. That's great. I want to try to go over everything and show you some things. Let me come back over here, and let's go ahead and talk about some questions here. I also want to show you the structural price failure that is coming into the market and why I believe we have to go higher. Now, obviously, let me add some context to that. Everything has got to be taken into context, ladies and gentlemen. We have to understand that wars, critical news events, global financial crisis events, any hypothetical disruption in global stability could be, assassination of a leader, or massive conflict takes place, or battles at sea, or even volcanoes, what have you. These things can change the markets very, very quickly. And in my opinion, the markets, and I've explained this to certain people on the phone and others, but I'm going to talk to you about it now. In my opinion, the markets operate on their own orders, so to say. It's almost like an orchestra having many multiple parts, many intermarket dynamics at play, and operating kind of in their own tune. So somebody hypothetically picks up a oboe and starts playing in the tune of G. Well, everybody kind of joins in around it, and it plays in that tune until it kind of wanes out, or someone uh, changes the course of the tempo and or the tune, and then boom, it moves to a tune of E. And then everybody moves to the tune of E and plays to the tune of E. And that's what my price amplitude arcs are all about, is trying to identify those shifts in price pattern. But again, we are right now playing in a mode I'm going to show you here on a weekly basis that is likely to continue to play out as we move forward, and is likely going to stay in tune. Think of this as the base bottom, and this is the top. Here, we'll try to draw it for you. So we'll come down here. There's one mode of operation. Let's call that one event, or one uh, chorus, song, what have you. And then here's essentially the other, a new mode of operation, now moving higher. Now, I do believe until this low is breached, let's go away right now, until this low is breached, because we do not have any new unique standout lows based on Fibonacci price theory, this is our critical low. I mean, we're close with this low. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Yeah, see, it doesn't make it. 11, 12, 13. So this doesn't make a new standout low. We would move likely up to, so in my theory, I'm counting this as A, I'm counting this as B, I'm counting this as, let's call it C1, C2, C3, likely to get up to 421, C4 possibly, and then C5 maybe. Okay, now C4 and C5 up here may or may not actually come in this time frame. In reality, all I'm counting on, if you look at this is wave one, this is wave two, and this is going to be wave three up into 421, 430, 435, and then we're going to get into wave four. Sorry, so 1, 2, 3. Yep, that's correct, and then four, and then eventually we're going to move into wave five here, which is going to come up and attempt to move up into this area. So this really, if you count this, you look here, A, B, C, D, E, a perfect 5-wave structure. Okay, I don't know if you can see that. Oops. But if I go back to daily, you can see this perfect wave right here. This is the bottom. And you can see this perfect wave here. We come up, we have our A, B, C, D, and then we go into a wave E, which is fairly complex, but the wave E comes all the way up to here, back to here, and back to here. There's actually, you can see here, an A, B, C, D with a deeper low here, still not below this C level, and then an E up here. And that's the thing with Elliott wave. There's certain rules that most people don't understand, and that is that wave one cannot be the longest wave in the cycle. So understand that when we take a look at this move here, we would have to determine whether or not this, I'll change the color, so I'm measuring what I hypothetically believe to be wave one, is bigger than this. So was, and let me put this back, clone it, come here, clone. Wave one cannot be the biggest wave of any Elliott wave cycle. So now, if this is wave one, and this is wave two, and this is wave three, was wave three bigger? I'll show you that it was up here. It was bigger, 480 points versus 427 points. Structurally, this is allowed. This is okay. You can count it like this. If wave one was bigger than wave C, or wave A was bigger than wave C, it would be structurally invalid. It cannot exist in that manner. That would mean that wave one would have to be something like this. You'd have to call this wave one, And then this would be wave 2, and then A, B, C, wave 3, correction possibly down to wave 4, and then A, B, C to wave 5. So I'm teaching you something that I want you to understand. Wave 1 can never be the longest wave. Okay. So if we go back here and we'll take a look at this, get rid of this, get rid of this, get rid of this, go back to weekly, and understand that now we here to this beautiful chart, and I get rid of all my squiggly lines and take a look at this and say, okay, so from a weekly standpoint, this is wave 1. This is potentially wave 2 with its unique low here. Now, can we safely assume that wave 1 is structurally the smallest wave? Look at this. You see all this empty space right up here? Let me try to draw this. Everything from here up to there. In order for price to validate this as wave 1, price must extend beyond wave 1's length in wave C or wave 3. That means that we have this entire range. We have potentially another 255 points in this ES chart to move up to match wave 1's impulse wave. So understand that ideally, ladies and gentlemen, wave 1 will not move, or wave 3, excuse me, will not move into any form of confirmation until we get above something like this level. I'll put this in gold. That tells us that now we've confirmed wave 1. We are now confirming wave 3 up above 44.65 roughly. We're confirming wave 3 as the bigger wave. And that now tells us that we have confirmed this bottom and we have confirmed this B-shaped formation here, which is very short, but is still a B. And that tells us that we still have the 421, the 431, the 435, the 440, the 449, the 450 level. And ideally, we are likely going to move up into this area at some point, which is our Fibonacci. Again, Fibonacci price theory, which I've just now started to teach you. There's a lot of rules to it. I'm not going to try to teach you every single rule that I've learned over the last 11 years, but I am going to teach you and continue to repeatedly state that price is always seeking new highs and new lows. Always. It doesn't matter if it's in a range. It doesn't matter if it's consolidating. It doesn't matter if the range is big or small. If you see something like we're in a range, kind of like we are here, I'll mark this as I'll mark that as red. I'll mark this as light green. I'll mark this as green because any break above this theoretically is going to be bullish. So in theory, ladies and gentlemen, we have our current unique high is this double top right here. I'll set this as a dotted line. Our current unique low is this area right here, and I will set this as a dotted line, and I will extend this out. So here's our range. Between this dotted line and this dotted line, these are our unique high and lows. When I say unique, that means that these are the broad market range, the upper and lower range of the market that we are now focused on for the market to be able to break above or below this level. Okay, it has to get above this level to establish new highs, and it has to get below this level to establish new lows. None of these are unique lows. These are what are called standout lows. And standout lows, we will likely get a standout low here only if, ladies and gentlemen, we get higher lows next week and higher closes and it starts to move higher, which confirms my 421 to 425 target. But we have a standout low here. Got to change it real quick. And I sent you this or showed it to you in a chart the other day. And we have a standout low here. Now, what makes these standout lows versus unique lows? Very simple. I want to do it with you right now visually. Can I see that price has touched this level last 10, 15, or say 20 bars? Now, it depends on how you're looking at the chart. Okay. So if you're looking at an interval of weekly, 10, 15, 16, 17, maybe bars is about as far back as you want to go. Daily, you'd want to maybe go 10 to 18, maybe 20. So it's up to you. On down on a 2 minute or a 5 minute, a minimum of roughly 15 to 20 bars. It's basically time. How much time has price stayed away from hitting this level before? Now, if it ultimately comes down and double bottoms or double tops within the 15 or 20 bars or hour, 2 hours, whatever you decide, then you're seeing what's called a double bottom or a reconfirmation of support or a double top, which is what we have right here. This is a reconfirmation of resistance. Price is coming up to this area, it's moving up to this area, it's trying to breach this area, and it's stalled right at this previous resistance area. That happens. And these can provide very good short term signals for this pullback that we saw. These 3 days downward move had a great opportunity to pull back off of this double topping formation. But we must not lose track of the fact that in reality, we had a standout high right here moving to the upside, which just got breached. We have our last standout high back here that got breached to the upside. So in essence, what we have here, ladies and gentlemen, is that we have a confirmation of a bullish trend here. We have confirmation of a bullish trend here. We have confirmation, almost confirmation. Let me look for another one. We have no breakdown of a bearish trend that I can actually identify here. So since this area here, we've got no confirmation on a weekly ES chart of a breakdown of a bearish trend. The only confirmation of the bearish trend I can tell you is right here. So here is the last confirmation. There are others. You can see them here. Here's another one here. And again, this is how I see the market. So when you're hearing me tell you that we have this or that or whatever set up, I'm actually looking at the market in this way. And I am applying my price amplitude arcs at the same point in time, trying to figure out where energy levels are going to confluence, where they're going to come together and point to a top. But generally, these rules that I'm teaching you apply. And this is what we're at. We're on a weekly basis. We have this breakout to the upside. We have this breakout to the upside on a daily basis. We had this breakdown was bearish. And as I showed you back over here, we had, a beautiful little double on this ES chart. These are standout lows. These are not unique lows. But you see how we broke through it and then confirmed? This told us right here that we were bearish as of this week, as of this week. So I'll draw a little arrow and told us really right there that we were bearish. Now, all the way up, you can see little standout highs and more standout highs up here. So I could show you how we briefly went bullish here, rolled downward. As soon as we failed back below this level, it negated the trigger. And that's the trick with these standout highs and lows. So hypothetically, when we got above this level here, we went bullish. When we got below this level, it became neutral. Our last trigger was bullish, but we are now neutral. Let me explain this to you because this is important to understand. So here we went bullish on this bar. Confirmed. We were waiting for confirmation. It didn't get confirmation. It came back and went neutral. At that point, this level revalidates. It turns back on. At this bar, when it comes back below it, this now becomes our last new high. We don't know this is a high yet. It is literally a new high, but we don't have confirmation of it being a pivot high. And we won't until we get a lower low, lower high, lower close, theoretically, or in general case, lower high, lower high, lower close. Got to kind of turn into a pivot. A pivot's typically like this, 1 to 2 bars either side with a unique or standout high. So at this point, it rallies back above it. And as soon as we get back above it, right over here, we now have confirmation that we are still long. Because why? In theory, ladies and gentlemen, it needed to break, if we were to look at it, it needed to break this range. right here at this black bar, we have this range. Remember, price is always attempting to establish new highs or new lows. Okay, so given that logic, knowing that we just broke this high right here, this Fibonacci standout high price right here, and knowing that we've gone back into neutral territory, it's either got to come down and take this low out, which would be a new downward trend, or it's going to reverse back up and take this level back out again, which would be confirmation of our upward trend. So there's really a plan A and a plan B over every circumstance. So in this scenario, we rallied up, we got our little unique low here. So let me highlight this. Right there, we have a little standout high. Sorry, I called it unique. I do that all the time. I intermix them. But as you can see, we continued to move higher. And then we found a base, and it's still above this low. So as we're setting up these lows and moving up this level, okay, we're going to set this level up here as a high. I will grab this. We broke this level, confirmed our upward trend. So now we have the range. And if we go back to the range here at this level, now we're looking at this range. It's got to break this range in order to try to find new highs and lows. Then eventually we set this low up, and we now have this high back over here. Now these highs and lows act as independent ranges going forward. So when you have this scenario hasn't been breached, you have this one that has been breached. How do I know, Brad? How do I know what to look for? This level still is valid. So let me explain to you here. This level is still valid over here. Why is it still valid? Because it acts as a critical price threshold. The Fibonacci price structures teach you that price has real threshold. So as you can see, as we look back over here and we look back over these trends, you can see essentially here, this threshold, which is acting as support until it was broken, becomes a very valid threshold, moving to the right, changing the colors slightly so we can see it in different color. This has a very valid threshold right over here. You see how that area has now come back into play as a valid threshold. I would consider it secondary compared to any new thresholds that line up over here, but this is still a valid level and it has been rejected. So come take a look here at the daily chart. Zone out. I do love TradingView because of this ability to do these line drawings and such very quickly. But understand here, as you see how this support level's held and how it tried to hold up above this support level and then finally broke, rallied back up, held above it, became rejected here, rejected again here. That's this level playing out over and over again. And it actually goes all the way back to way over here, back over to February 24th of 2022. That is a support level identified by price using these Fibonacci price theory constructs in order to operate. So now let's go back to the bigger picture here. We're going to stick on the daily chart. I've shown you what's going on. We have this level here is our massive resistance area. This is our major unique or ultimate range. Then we have these levels up above here, which we have to watch. This level up here, which we have to watch. We also have let me highlight this. And again, I could probably spend an hour going through all of this with you, maybe more. There's another level. This is not a unique high because price actually touched it within 10, 15 bars roughly ago. And this is daily. So remember, I'm doing the adjustment between daily, weekly, and intraday patterns. Okay. So now we have these setups here. We have this last major trigger here. You can see on daily, we have a whole bunch of little intra-bar reversals that each one represents independent pivot patterns, just like I showed you over on my Fibonacci adaptive Fibonacci system. But again, you want to remember confirmation and rejection. Confirmation, and if we got rejection here, like hypothetically, if we got above this level here, and then it moved up here, stalled, moved back up above it, stalled, and moved back up above it, and then continued upward, that would still be confirmation to the upside. That little stalling pattern is essentially neutral triggering, trying to break above it. It did break it. It did clear that level on a closing price basis, but it did not physically confirm until we finally had the second close, subsequent close up above that level. And that means then we're looking at the next level. Price is always trying to find new highs and new lows, or new lows. So if it's taking out new highs, it's going to continue to take out new highs until, guess what? It decides it can't do that anymore. Then it's going to try to take new lows out. That's always what it does. It's always trying to find new highs or new lows. All you need to do is be on the right side of it. So trying to short into a bullish trending market is difficult. Yeah, we had a decent little pullback. If you can see here, I mean, yeah, on a short term trading basis, you could look at this and you could say, hey, look at these little pivot lows right here and down here. And there might be some even over here. I don't see any. There's one here. There's one here. There's one here. There's a couple. There's one right here. There's one down here. And I could probably go back and find a few more back here. Pivot high right here, which is beautiful. Look at how that lines up with our February low right here. So this is a little off. But you see how these highs and lows act as support and resistance going forward for price. So now, what we're looking at here again is the failure of the wave one range to be superseded by a wave three range. Wave three must clear this level. Otherwise, we have to reassume, and I will show you, this is wave one based on my primary analysis. So we have wave 1, 2, 3 must clear this level up here. Absolutely has to in order for this to be valid. So that means price has to go up into this area. Secondarily, if I'm wrong, what we have here is we do not have a proper confirmation of a rally phase, an ABC rally phase. What we would then have is we would have something more along the lines of mouse. We would have more along the lines of a wave one here, a wave two here, which would be complex, be an A, B, C, D, E. Okay, so let's now take a look at the rules still apply. So now if that is incorrect, this wave one has to be superseded. It cannot be the longest wave. Clone. Wave three must breach wave one, which it does, barely. You see this little gap right here between the high here and the little dot up here. So wave three here breaches wave one range, assuming I've drawn this correctly. And that would mean that this could set up as an A, B, C would be this, possibly here. Or we could have and this is why Elliott wave sucks. Elliott wave is very bad at in trying to forward analyze anything. At this point, these wave structures depend on really what happens in wave 4 and wave 5. It's just useful in trying to figure out where price may go. But understand that if this is the case where we have a wave 1, then a wave 2, then potentially a wave 3 to here, then a wave 4, this means that if this is wave 3 here, from here to here, then wave 5 is likely going to be roughly 61.8% to 150% of wave C. So if that's wave C and this is wave E, that still puts us up in the 430, 435 area. That would be 100% 618% would put us into the 421 area. So did you see how all of this lines up? If my original analysis is correct, and this is A, this is B, now we're in a wave C trying to move higher, we have to get up into this area. So understand that just logically, we have to get here for it to be a valid price structure. In an alternate count, if I count this like this, we still have to get up here. Somewhere up in this area, I'll draw another box. We still have to get somewhere up in this area for it to become a valid peak, which lines up again with my May 10th to May 20th, roughly peaking above 421. And that is again what I believe is likely to happen. Now, if we fail at this point, okay, this means that and I will count the alternate structure so you can see it. If we fail at this point and we do not get above this level, we do not get above this little dot, 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 dot level. Now I'm going to throw a curveball at you, and I want you to think in terms of plan A, plan B. Every trader must have a plan A and a plan B. Okay. So plan B would be that this becomes a double top right here. This becomes our A, B, C, D, E, end of wave. So this would become E, text, E. That would be our end of wave. Again, A, B, C, D, E. This would be end of wave. This would be beginning of A correction, B correction, setting up a double top formation, leading to a potential downward move, which must clear this level, and setting up some sort of a C downside move. So this is again, when we start thinking about this from price structure and longer term, I want you to realize that we now have talked about three separate outcomes. Two of them are bullish, reconfirming my targeted outcome up here. C, the third one is an alternate where this becomes a critical top, a double topping formation, ending the wave here, beginning a new wave structure here with a double topping formation, and must then come down and close out and breach below these lows, or particularly, at least you can see we have a little kind of a double bottoming formation here, right up here. So there's our next standout lows right there. This is actually almost a unique low. I bet you there's 15, 18 bars in between there. Okay, so this teaches us again what to expect and how we want to run with it. So from a broader term picture, when we look at it, we're in an A, B, C formation targeting this area. Okay, that's my long-term interpretation. In a backup alternate interpretation, we've already had our completed wave here, moving into a double top, potentially moving downward. Until I see confirmation of this downward trend on the daily or the weekly, I am in no way acting on this downward move. I do not have confirmation that this is the end of the trend yet, because I do not have any breaching of these downward levels. So I'm not really expecting any downward price action until we start to get some real confirmation that the trend is moving downward. Okay. I hope this has been instructive. You guys have been very quiet. And again, the markets, as I mentioned to Ann, I think, Ann, I was talking to you many months ago. Let me see if I can find the other chart. Oh, here it is. So this has my price amplitude data. Drag this out of the way. Drag this out of the way. Now, the price amplitude arcs add a whole other world to this, okay? Because the price amplitude arcs actually show us where price is reaching and or breaching this criteria, the price energy waves. So you can see this arc here, this dark gray arc comes all the way down here, across this top, down into these areas, found support in this area, and then completely rejected back up into this area. So now we're looking for this trend to follow through back up to new highs, which hopefully will put us up into this target area within 2 or 3 weeks, which is this little box right right there. And that's where my expectations are at the moment. If we were to get some downward confirmation, I would be saying, okay, time to change direction. I don't see that happening yet. I believe that this next amplitude arc, this green arc right here, is going to act as support. Okay, we saw how we rallied through here, reached the peak, found support here, double supported. We've double topped. It's almost like it's mirroring itself. It peaked, came back down. There's actually the double top over here. So it peaked, came back down, double supported, rallying back up. I think now's the time. It must try to break this level. It must try to get above these upper areas. And if it rejects up here a third time, then yeah, we're probably going to lose a lot of momentum and try to come back down. So that's what I really think is the outcome. And we want to play this effectively. Remember, you only have what, maybe 3 or 4%. So from this current price level, you've got 3.5% to get up into the 426, 427 area. So remember, you're going to be looking at this as a short term move. Once we get up above 424, 425, you really want to watch your nickels and dimes and be cautious. There's not going to be a whole lot of opportunity, in my opinion, up in that area. But again, if we get down below this 404 level, let's call it, in reality, it's kind of a double bottom, 403.77 and 403.80, then yeah, we're going to be looking at a deeper downside move, possibly back down into this area. So I'll draw a little ellipse because this is, you can see the price amplitude arcs here. It's kind of hard to see on this chart, but there's one here, there's one here, there's one here, there's another one over here. I would say that like this area becomes our real downside target area for a pullback. And interestingly enough, if you take a look at this is still above the ultimate low. This would be nothing more than a correction as long as we do not take out this extreme low back over here. This is our ultimate low. This is the one that tells us we are now very confirmed in a bearish trend until we have some new ultimate low form over here. This would be the area I would expect to find some support back in this area around this diamond. Jason, how long have I been using systems? Did this map out the 2022 bear market or the 2018 or 2020 decline? Yeah, generally it maps everything, Jason. The Fibonacci price theory. Now remember, there's a lot of rules to it. There's a lot of interpretation. You have to understand that it applies to an A, B trade structure. Think of that as plan to fail, plan to succeed. And yes, it pretty much maps out every move. So, I'll give you an example. This is the SPY chart. We can go back, pick a time. Let me zoom it out here. This is daily. So just about every major correction has been identified through Fibonacci price structure. Now you can see here, and these zigzag indicator, I love it for the simple reason that it finds really great, critical and ultimate tops and bottoms for me. It ignores some of them, like right here, but it finds some really good tops and bottoms. Okay, so this is daily. And of course, well, let's go to weekly because this is where weekly, I love weekly simply because it provides real solid trend confirmation. So here's our 2000 peak right over here. So here's our 2000 peak. And all we need to do is start watching for these lows. So as you come in here, we get a breakout. We'll just use these pivot point lows because there are others down here you can see. But you can see it broke through and then rejected. Okay. Short below this level looking for confirmation, long above this level looking for confirmation. We get confirmation, we stay long. We establish a new standout low here, rejected, confirmed, rejected, rallied up, came back up, set up a new low, rallied up, set up a new low here, never got closed below it, came very close here, rallied up, set up a new low here, broke below it, confirmed, then rejected. This becomes our new ultimate low right here. So we have a couple of them. right here, right here, and right here. This is actually more of a double bottoming formation, so I'll just grab that one. Okay, now understand that Fibonacci price theory is telling you which way price is going. Okay, but there's intermarket dynamics. Like when I come over here real quick, when I come over here and I show you my dynamics via my live trades, trying to get to the images real here. Thank goodness for this other monitor. So, for example, when I come and take a look at the U.S. valuation index right here, okay, we need to provide some context to the price action. So think of it as a trigger. You have a trigger with no context. Does that mean start the race? Does that mean get ready? Is it ready, set, or go? If it's ready, get ready. If it's set, make sure you're set. If it's go, go. So you have to have some context into what's actually taking place and how the market is setting up, which is why the triggering mechanisms like the Fibonacci price theory or the Ment rotational modeling system or anything else, understand that it has to have context. You have to determine the context of the market. Like I've tried to tell Ann, I mentioned earlier, the markets are in a totally different world. The markets are flush with cash. In my opinion, the global markets are the biggest risk to the global economy right now, not the US markets, although the US markets could become at risk if things get out of control. I believe the Fed is more than capable of withstanding some of these regional banking issues and facilitating credit as needed to move us through this. I think the biggest disruption, as I mentioned to Jason recently, is a global crisis, a foreign market crisis where extended economic contraction, imagine 5 to 7, maybe 10 years of economic contraction of maybe 10 to 15%, 7 to 15% a year, puts extreme pressure on global manufacturing and global supply. So understand what happens to Saudi Arabia hypothetically if oil moves to $40 or $50 and stays there for 7 to 10 years while the global markets contract. What happens to China if global markets contract 7 to 10, 15% for the next 7 to 10 years while they've increased all of this credit and their corporations and their state-owned enterprises now have all this debt to settle? Essentially, there is no growth in the economy in this environment, and I think the post-COVID world could move into that kind of an environment where growth becomes difficult for the next 7 to 10 years, real organic growth, unless we move into the extended money printing, which would be foolish. It would provide growth, but it would provide hyperinflation and everything would come crashing down at some point. So the markets need context. All of these triggers need context to keep you on the right side of trend. They're not just follow these triggers. Follow these triggers in context to what's going on in the global markets, and you're going to see some real definition. So now, again, we come back out here and go to monthly. Remember, it works in any time frame. Monthly, you don't always get these types of breakdowns, okay? But you can see very clearly we had the very clear pivot points indicating a breakdown in the market. This is 2000, Jason. And then you come back over here to 2020 or 2006, 7, 8. You can see this breakdown here. You can see this breakdown here. And you can see this breakdown here. And as we get into these breakdown areas, you can then start to see that we keep channeling downward. So look, new lows, break down below new lows, new low, break down below new low, new low, break down below new low, and then finally rejection. We get the high here. Finally, we get confirmation of an uptrend right here. Again, it has to be in context. So at this point, 2000 March, June, July 2010, we had confirmation of an uptrend with this trigger right here. We had the Fed stepping in to rescue Goldman and everybody else. So is this proper context? Yeah, in a way, it provides proper context for a recovery phase. And you can see it also helped keep you away from some of these failed moves like this. So understand here in a general context, oh, look out, confirmation of a downtrend. Nope, that's the breach trigger. This is rejection. Secondary confirmation never happened. So this was okay. We could go bearish. We now have rejected the bearish trigger. We're back to bullish. At this point, we're looking for any new move below that level on a closing basis. We don't really get it. So we're basically staying bullish all the way up. This was a little bit of a deeper move in 2011. You can see we broke through this here, then established this move here and went long with this confirmation right here off of this high. It works in any time frame, ladies and gentlemen. It does. It works in any time frame. You just have to be aware of the range. If the range is too large for you on a daily or weekly basis or monthly basis, then go back into a 4 hour and take a look at the ranges on the 4 hour basis. If that doesn't work, go to 1 hour. And if that doesn't work, try a 15 or a 20 or a 30 minute, and you'll be able to see these ranges. Okay, so now I have probably almost gone my hour. Um, are there any comments or questions you guys have right now? Jason, the system you're showing us in the beginning, the system I was showing you in the predictive modeling system, this one, Jason. So it would be this one. This is called the adaptive dynamic learning system. Okay, the adaptive dynamic learning system. One weekend many years ago, I decided I was sick and tired of predictive modeling systems that were date time based and or other criteria based. And if any of you are familiar with an XY chart, say yes if you're familiar with an XY chart on the chat room. So imagine an XY chart. Oh, you're welcome, man. I appreciate it. So if you're familiar with an XY chart, this is an XY chart, by the way. Okay. An XY chart is vertical is the Y coordination or Y axis, and X is in this case, the date axis, the horizontal axis. So let me come in here and try to draw something for you if it loads. This is one of my favorite little drawing tools. So, on an XY uh, axis, oh, that's not going to work. Make something bigger. So, let's come back here. Hold on, folks. Just going to take and copy something that's bigger like this. Copy. Come back here, control new. And now it gives me a bigger screen to work with. So, I will fill the background with white. And here is an XY chart. So what I'm going to try to do is I'm going to try to draw an XY chart like this. So here is a basic XY chart. Okay. We have the Y axis going up and down and the X axis going over here. And typically what you would have in the middle is you would have yeah, that'll work. You'd have some sort of a chart over here doing something, right? That's what we're used to seeing. Date and price. Okay. I wanted to create something that mapped price activity in a different structure. So, what I did, ladies and gentlemen, is I went and let me get rid of this. That's Jamie. He must have just landed. And what I did is I created a quadrant system. So, I created this. Now, let me do these. I'll grab both of these. Try to drag these. Okay. So I created a quadrant system like this. And what I did is this would be considered, let's call this positive, and this is the wrong color. positive price data. I'm calling that positive because it's on the right side. Okay, and I would call this. Let's change that. So let's go plus plus price data or technical data, whatever it happens to be. And CV, drag this down here. CV, drag this over here. CV, drag this over here. So now what I did is I created this in a standpoint of this will be so upper quadrant. So we'll go upper quadrant, white, right quadrant, and then this will be upper quadrant, left quadrant. So this would be negative. Oops. And this would be negative, negative. This would be negative, positive. So it sounds difficult to understand, but imagine I created this as price patterns. Imagine I created this as technical patterns. I'm trying to type all this in for you. Imagine I created this as, let's call it cycle patterns. And imagine I created this as candle patterns. Okay, so what I end up with is what I call a scatter chart. What a scatter chart looks like is as we're mapping the data and as we get into these areas, soft rounded, okay, that'll be, so I'll end up, as I map price data, I'll end up getting a blip and then a blip and then a blip, 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 maybe a couple blips out here. And then I'll end up getting blips down here, mapping out price technical patterns. And then I'll end up getting cycle pattern blips over here. And then I'll end up getting candle pattern blips over here. I call it a scatter chart. Now, what I can do, imagine I have these blips. It's like a Rorschach test, right? What I can do is now I've mapped these patterns in 4 separate quadrants. And now I can take a look at any new pattern within a 10, 15, or 20 degree variance of each of these blips, depending on the scale of the XY coordinate. Remember, this is the Y coordinate here. I don't know where everything, there it goes. Lost everything. This is the Y coordinate and this is the X coordinate. Okay, so in essence, and I will drag this to here and drag this to here. So depending on the Y and the X coordinate, I have this scatter. I built it so it can map this out in a scatter chart. And then I built a lookup routine. And the lookup routine allows me to look up for patterns with variances within a 10, 15, 20, 30 degree variance. So it's much more depth of context in looking for patterns. And this is what the adaptive dynamic learning system essentially does. Depending on how I map the data and how critical I map the data, we get all kinds of information. So when I map the data, like for example, AAPL, we go to Apple, we take a look. I want to see what's going to happen over the last 10 or 15 days. First thing I do is within the last, this is weekly, I want to see tops and bottoms and or dojis. So I'm going to start with this bottom, map that one, map these little areas as tops. Then I'm going to go to dojis and I'm going to take a look at what the dojis say. So everything says that Apple essentially has already reached a peak. It's going to consolidate. This is what this is telling me by looking at this data. Pay attention here. Where are the data coordinates? Right here. Okay. It tells me that it's going to peak. It tells me that it's going to move downward from this area, likely down into this 160, 165 area. And then potentially come, I got to look at the time, June, July, August, which is where my bottom is expected to set up, it'll start to move higher. Okay. Jason, does that help? Yes, Ann, it is highly technical. That's remember, I am a programmer. I can build anything that I want. In context, if I get a wild idea, I can spend 3 weeks or 4 weeks or 10 years building something very, very cool. Now I'm also very good at building what are called adaptive learning models, which are inference engines. I've been doing that for 25 years. It's a form of artificial intelligence. Really, what it is, the problem with artificial intelligence is it doesn't know the difference between a ball or the moon or a pizza pie until it gets to be able to develop context. And that's what adaptive learning is about. Adaptive learning is about finding uh, hold on, finding the proper context in making decisions. So it's not about the data. It's not about having more data. It's about being able to read the data effectively for what's immediately in front of us. And a best example of that is probably these Tesla cars, that fail road tests or do something funny. The idea is artificial intelligence is great, but having the proper context of knowing what to do in the next 10, 15, 20 seconds or minutes or days is very much the most important aspect of anything that we do. It's not about what I think is going to happen 3 years from now. It's what I think is going to happen, 10 minutes, 15 minutes, 20 minutes, 10 to 15, 20 days into the future to help you. Now, I develop context in all of my reporting. So the Ment rotational modeling system is context for longer term investors. The daily cycle patterns, the SPY cycle patterns, gold cycle patterns are more for daily, weekly traders. And then I have other tools for intraday stuff. I'm really not trying to focus on the 10-minute, 1 minute, 2 minute stuff for traders because I don't have the time, especially with now two disabled people in my family uh, and having a wife and a son and having to deal with all of that, which I've pretty much been ignoring for the last 3 weeks. They're operating on their own. My wife's handling everything, but it's all about context. So remember, as I give you this information, I'm trying to provide you the best information I can without being right over your shoulder trying to tell you every 2 minutes what to do. And Jason, you asked about the MMT version. I'm not sure I understand what MMT is. Oh, Jamie, can you hear me? I don't know if you've turned on your microphone. Jamie's here, but Jamie, we're going to have to wrap this up and do it again. This was the introductory one. Everything is working. We have another webinar set up on Wednesday of next week. So if you can make it, we'll go ahead and show everyone the clockwork group strategies next in the next webinar. I'm glad you got back safe. But Jason, message me um, on the MMT. I don't understand what MMT is. Yeah, perfect, Jamie. Thank you. I can't hear you. I don't know if did you log in under the co-presenter link? Again, we'll have to learn how to do this with co-presenting, but Jason, what's MMT? I'm not sure Jason is still here.
Am I here?
Yeah, I got you, Jamie.
Okay.
Turn your volume up a bit.
Um, okay.
That's better.
All right. Well, we'll get the model ironed out here.
Yeah, you were traveling. I knew you were going to be late. I warned everybody at the beginning. Everybody, this is Jamie Marks. He's been a friend of mine for a little over 12 years. I think, we've been in the same circle for 20 plus years, but we've been friends for about 12 years. And this webinar was really going to be about him, but it's actually a good thing because I got everybody in here and got them set up and kind of showed them what was going on. But next time, we're going to do the oh, rotational modeling. Okay, yeah, I got it. MRM, I got it. So let me handle this with Jamie and then hold on because we're going to wrap it up. We're a little over our hour right now. I'm going to try to do these about an hour and 20 minutes if we get wrapped up in stuff. But this is the first one. It works, so we can do more. That's what I really like about it. And the next one, Jamie, I'm going to redo it, and it's all going to be about Clockwork Group. So everybody, the benefit of Clockwork Group software is these are fully automated, totally proven. intraday and longer term swing trading type strategies that I urge you to consider adopting. The whole point behind having systems that are capable of growing your account for you is that you don't have to think about it. You can just allocate a small amount of money, relatively small amount of money, over to these strategies and let them do what they're supposed to do for you, which is grow your account. You know, we've got pro forma reports that show using the base, we call the core strategies, very slow, not very aggressive. They don't trade that often. You know, can grow your account 30 to 60% return on investment annually. And when you start doing that with futures and compounding the revenue growth, it can grow over 3 to 5 years into an incredible amount of money. I mean, you could start with a quarter, or 200,000 or $100,000, and over 5 years, if you compounded everything efficiently, you might end up with a couple $1 million within 3 to 5 years. But that's what we're going to do in the next Clockwork Group webinar. So now, yeah, go ahead and say hi to everybody. You're going to start to see a lot of Jamie, and we're going to have other guest speakers in here. Now, back to where was it? Long-term system showing us Jason. Oh, the faster MMT, the rotational modeling system. Okay, let me also explain this. So the rotational modeling system that we rely upon for our investment strategies at Mint.com, very slow, very solid, really only trades maybe 5, maybe 7 times a year. It really doesn't when the market's trending. It does trade a little bit more often when the market's sideways. But I've been working on a version of a more aggressive rotational modeling system. I don't know what I'm going to call it yet, but it is going very well. I'm working out the process and the logic control for it. I have found a way to successfully build possibly another 30 to 40%, possibly annually, into the system using this slightly aggressive mode. But I'm not ready to show it yet. And given the fact that my brother's in a rehab and my father's in a wheelchair, my brother's going to be coming home in a wheelchair and probably going through 2 months or more of doctors and rehab, what have you. I'm going to try to get it done, Jason. It's just I have got my hands full with the family medical issues. So I really appreciate everyone's patience. And Jamie, did you have any problems getting in?
Not problems. Just had uh, a conflict in schedule. I thought this was on for my time, starting at 3 o'clock. It's 4 o'clock, 4:11 Eastern. So I missed that part of it. Other than that, no. I think
Yeah,
this
you're
is
real soft again.
I think this is
Oh,
straightforward.
okay, there you go. Okay,
Okay,
good.
possibly.
Well, I had this messed up. I originally had it set up to um 12 a.m. Just stupid
Okay,
me,
no
right? I
worries.
set it
Listen,
up.
the idea is, I think, hopefully that we'll be able to catch a window that'll be live trading. We can actually show some of the algorithms into the last hour of trading and end of day closes. So that might be exciting.
That's
Just
why
to
I'm
leave
trying
that
to set
window.
these up. Yeah,
Yep.
if you go out to the website, Jamie, and you see how I've set all these up, so over on the live events page, I've got these things pretty much setting up at 12 noon, and then 12 noon, and then I have the lead lag report with Michael, who's very good, and thank you, Jason, for nudging Michael. And then we have the member only training at 10 a.m. We could maybe highlight some of that stuff, the Clockwork Group there. And then we have the other intro to Clockwork Group strategies on the 19th, okay, at 12 noon. That gives us the last hour of trading. We can go over what's going on with it. Okay.
Okay, fine.
Okay.
That works.
Well, I think that's it today, everybody. Thank you for showing up. Like I said, we're going to get your welcome, man. We're going to get more of these things going. And again, thank you for the patience. I've got a lot of work to do this weekend to get all the weekend updates done, but I really am glad that everybody's enjoying what I'm doing and learning. And that's the whole point. Like I told you, I really am trying to price this at a very inexpensive level for the context and content that I'm delivering. And my goal, my purpose is to try to help you guys. I think the next 7 to 10 years are going to be very, very dangerous. I keep reading that all these people are trying to short the markets, and they're taking losses. I read about one guy the other day who's lost 65% of his portfolio trying to short the market over the last month. It's just there's a lot of really, I don't want to say foolish, but there's a lot of crazy out there. And what you want to do is you want to try to stick with something that works, make your own decisions, and protect your capital, which is what I'm trying to teach you how to do. Is to learn to fight another day, not go crazy trying to just
Hit home
trade
runs.
what
Yeah.
looks like the hype of the day. Okay, guys, I think that's it for
All right.
now.
Enjoy
You're
your
welcome.
weekend.
Have a great weekend. Jamie, thanks for joining. I really appreciate it. We'll talk later.
Likewise. Bye bye.